Today we're going to talk about down payments, something that you just plain have to have these days. The days of zero down payment, of no doc loans are gone, and the amount, there's confusion about how much money people need to have for various different programs or types of loans. There's confusion about where that money can come from. Can it be a loan? Does it have to be in the bank account seasons for some period of time? So let's jump into a general conversation about down payments and the sources of those funds, and then maybe talk more specifically about a secret source maybe of where those funds might come from, or something that people just don't normally think about.
Okay, that sounds good. Let's do that.
Awesome.
So generally speaking, you need to have a down payment of anywhere from 3% to 5%, depending on the loan program you're doing.
3 to 5?
3 to 5%. 3%. Some conventional loans you can do 3%, and FHA loans are 3.5%. So that's the very minimum available. So assuming that you're not going to get any assistance from the state and MHDC loans or other area municipalities maybe that may have funds available.
Right.
If you're going to get your own money, then the question is, what sources can you use? And typically the money has to be in your bank account for 60 days.
Yeah, but wait a minute. You're saying 3 to 5%. I mean, that's not normal. I mean, the normal down payment these days is, it may not be 20%, but that's what most lenders are still looking for, is a 20% down, right?
Well, I mean, a lender would like to have 20% down, I suppose, because it reduces their risk. But
right.
We do, thousands of loans with 3 to 5% down.
So that's awesome. So, just to put numbers to it, if the average house in St. Louis area is just under $200,000, let's say 200,
$6,000.
Someone has $6,000, they can get into a pretty nice house just about in any place in the St. Louis area.
That's right. Yeah.
And take that number just a little further. If someone's going to have a $200,000 house and they're going to put 6% down, they're going to have 3% down. That's $6,000. $194. They're going to have $2,000 or $3,000 in closing costs. A mortgage of $190,000, $194. Just a typical 4 times factor for a house payment is going to be, what is that? $650 a month.
Oh, just for the principal and interest payment?
Exactly.
It's probably, if you're talking about $200,000, close to $200,000, you'd probably
800.
Yeah, $800 to $1,000 probably
to
principal.
$1,000,
yeah,
right.
depending on the rate, and rates are very attractive, as you well know.
Right, but I'm just saying that for the typical $200,000 house, you're talking about a minimum down payment of $3,000. So let's just say
3%.
At 3% of $6,000. I'm just getting my numbers.
That's why I'm here, Mr. Damian.
I appreciate you showing up today, because my brain, I think I left my brain back in the office. 3% down,
yep.
$6,000. You're looking at a house payment for principal and interest of about $800 a month, and your insurance is going to be about $100
a month,
and your taxes are going to be about $200 a month.
Your mortgage insurance, if you're putting that amount down, would typically be $150 to $200 a month, again, depending on your loan program. That's just general.
Right. So, and I know that we're getting way off of the topic here about down payment, but I just want to make the point, because I think a lot of our listeners, especially first-time buyers who might be spending $800, $900 a month in rent and getting no benefit from their tax or from Uncle Sam about that. If you're paying $800 or $900 in rent, you could theoretically have the same after-tax cost of owning a house that is worth up to $200,000.
That's absolutely correct.
Okay, so I'll stop with that little message. It's hard not to go that route, because I think people, a lot of our listeners just don't get that until they have the conversation. So now they've had it, and that's good for them. So let's talk about sources of down payment. Mm-hmm. Can you can someone gift it to you? Can you borrow your down payment? Where can it come from?
Well, on a conventional or FHA loan, the whole down payment can be gifted from a relative.
Okay.
So that's a very attractive avenue if people have that ability to go, with a relative that's willing to do that. So my philosophy is, if they offer, take it. If they don't ask.
Or ask maybe just once or something. Knox, you could easily lend plenty of people 6% or 3% or whatever. Because
if it weren't illegal, that would be ideal.
That's right.
Yeah. Okay.
That would be great.
So, and another avenue is, many people, have 401k money.
Right.
And people often ask, can I take money out of my 401k for my down payment? And the answer is, of course, yes, you can. And there's certainly some pros and cons to doing that.
Such as?
Well, I am not a financial advisor, but a financial advisor would tell you that you should leave your retirement funds for retirement and not tap those.
Okay.
But if you have no other source, no other way to get the money for a down payment, then it's really not a bad option.
So would a person typically take that money out of the 401, or would they borrow against?
It would be a loan.
The
the best way to do it would be to borrow against it and take a loan. And so that way you don't have any tax penalties. It's not a withdrawal.
Right. So you're avoiding tax.
That's correct.
Right. Okay.
And so you're basically taking a loan against it. You're paying yourself back into your own account. You're earning interest on that account. So there's no qualifying process. Okay.
Right.
So you're just taking your money out. There's no credit check. There's just a couple of papers for your employer. Now, everybody would need to make sure if they're interested in doing that their employer allows it, that the plan allows it. So they'd have to check that first, because not all plans allow you to go take money.
And that just depends on who the
administrator
who
of the plan
administrated at
exactly.
what time and what the objective of the plan was itself. Right.
So it's easy to do. There's typically no cost to do it whatsoever. There's no credit check. So you're paying yourself back.
Well, when you say borrow against your 401, is there an interest expense on that borrowed fund?
That's typically
money?
what the plan administrator would be.
Okay.
But typically there's something. But remember, it's your money. You're paying yourself back that rate.
Right.
Okay, so those are some of the pros. It's easy enough to do. It's accessible. It's easy to get. You can get it quickly. Usually you can get that money in 3 to 5 days. But there's some drawbacks as well.
Well, and really, if you think about it, obviously, investment advisors and wealth planners, those guys are always going to want you to preserve your savings.
Correct.
That's what it's not something you do lightly, right? Because
Correct.
a 401 is an investment account to protect you after you are stopped working.
You have to consider all the different factors. Now, what we've found is that many people will just access it for a short period of time because they're getting money from a tax refund or some other source that just hasn't come through, and then put it back.
Right.
And that would be the perfect scenario.
And again, there's no fee for doing
Correct.
that. Depending on your plan. But also, I want to point out, too, that I think there's a big difference between a guy taking, say $20 or even $30 or $50,000 out of his 401 in order to create funds for a down payment on a house, which is an investment, which is something he owns and probably will at least for 7 to 10 years and possibly for 30. That's different than taking out, $2,000 to buy a TV or $50,000 to buy a new truck or something like that.
Yeah,
right?
that certainly wouldn't be advisable for sure.
Right. But I just think that, a lot of people might be shocked and might be thinking that we are encouraging them to borrow from their future. And while that it's a different use of those funds, I guess is the point that I want to make. It's not squandering or wasting that money.
Right. It's an appreciable, your retirement funds are going to appreciate. You're going to add to them. That's the idea. But obviously, your home can appreciate in value as well significantly. So that's the good trade-off.
Right.
But one of the considerations of some of the cons to it are that the big advantage of a 401k is you're taking it out and you're not paying tax on that. So that money is taken out of your pay and your taxes are deferred to the future.
Right.
But when you pay back a 401k loan, you're using after-tax money.
Gotcha.
And then therefore, since the money isn't in the investment account, it's not going to grow as quickly because you've taken some of that money out. So there's and it's hard to know what the long-term impact of that would be because you don't know what you're going to earn on your account anyway.
Right. And it's, it's just impossible to accurately predict what your return's going to be in a 401. It's impossible to accurately predict by any stretch what the appreciation of your house might be.
Yeah. And one other aspect of that is that, if you leave your job, you've got to pay it back usually within like 60 days. So that's something that you would have to be prepared for if you knew you were going to be leaving your job.
But especially if you're thinking about a down payment for a new house and maybe you have some money coming in, like you said, from a tax return or an asset sale, maybe it's just a capital gains trade-off, right? So you've got 3 shares of Apple that's now worth $10 million, but you've got to hold it for a couple of months just so you don't pay capital gains or something. Especially if you use it as a tool to get from this point in time to another, and that those funds are going to be there.
It's a good way to do that.
And you can put it back into your 401.
That's right. No penalty, no nothing.
Yeah, exactly.
Yeah.
Well, Mike, that is good stuff. I hope that if our listeners are thinking about whether they can get into the market and buy a house without having to have a 20% down payment. There are programs, there are loans
Absolutely.
that'll let you do it. There are lenders who have investors that are okay with that. And there are numerous ways to get those funds for the down payment, even if it's only 3 or 5%. And taking that out of your 401k or your retirement plan is not a bad thing. It's just a possible way to get it done. So
that's right.
Really appreciate you coming in today, as we always do.
Glad to be here.
If somebody wants more information about that, obviously they might talk to their wealth planner, their financial advisor, their HR administrator at work, whoever it is. But how would they reach you to find out more details just about how that works?
Well, just please call me at 314-503-6024. That's 314-503-6024. And you're welcome to text me at that number as well, and just put in 401k.
But don't text if you're driving. Text Mike Mudry at 314-503-6024 if you're not driving. And just, did you say text the word 401?
401k.
Just text the
401.
numbers 401, and Mike will get back with you.
You don't ever text and drive, do you?
I rarely text and drive.
Okay, I'm making sure.
And whenever I do, it's under duress. And I'm trying not to.